right, welcome everyone. Good morning. As we do every morning, we'll just wait a few minutes to get started and give everybody a chance to hop on here. Got the chat up there. People can drop a comment in the chat. Good morning. Good morning. All right, everybody checking in while we're waiting here. Thank you for everybody tuning in early. We're just waiting a couple minutes here. Let everybody have a chance to jump on and let us go live on all the different platforms. Hope everybody's been having a good week. We got a great topic to go over here today, so definitely excited for that. And let's just wait just another minute here. If you're just joining us, go ahead and drop a comment in the chat. And we appreciate everybody tuning in. Let's see. All right. Oh, a couple more people chiming in.
All right, ready to get started?
Yeah, let's go ahead and get started then. A little late today from some technical difficulties, but we'll go ahead and get into it. So, welcome everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. And just like we do every morning, today we're going to go through the live rates of all the different programs, everything from conventional to non-QM, which is what we actually specialize here in at the Mortgage Calculator, is non-QM loans. One of those great programs that we do offer as a non-QM product is an asset utilization program, some asset-based qualification loans, right? So a little bit later, Jose is going to do a deep dive into that. He's got some quotes pulled up of actual scenarios to do a deep dive into the asset-based loans. So we'll go through that in a little bit. But in the meantime, Nick is going to pull up the different rates that are actually live today. We do this every morning. You can see how the rates kind of fluctuate day to day. And so we will go ahead and get into that again today. So Nick, if you want to go ahead and pull up our pricing tool here and let everybody know what the rates are looking like today.
All right, so let's go ahead and let me switch my screens real quick, and we will pull up the pricer. And here we go. So this is our pricing tool for our team of licensed loan officers. So if you need a full loan estimate, please get with our team, and they can send you all the detailed breakdown. This is just going to give us an indication of the pricing today for our basic programs. It is February 28th, just after 11 a.m. So most of our programs are all live with pricing here in the tool. So we can check out the general markets are doing. And again, get with our teammates if you'd like a detailed quote. For all of our scenarios today, we are going to use an estimated LTV of 80%, and that would mean 20% down payment. We're going to keep the loan amount at $400,000, nice regular amount. We're going to do a desired price of 99. What that means is we're going to tell the computer to find the best rates at one discount point in cost. Most of our clients are asking to buy down the rate a little bit, so that's typically the scenario we are getting asked for. And for today's show, we're going to go through the conforming conventional options. We're also going to pop up usually the next best options, usually FHA. And then, fortunately, we have over 4,500 loan programs under our expanded guidelines non-QM for alternative options for our borrowers who may not qualify for conforming or FHA. So we'll go through some options there as well. For VA, we do a couple shows on that. If you'd like a detailed breakdown of VA, we appreciate the vets that are qualified, but since not everybody can qualify, only our qualified veterans, we won't do that live on the show. And same thing with USDA. We did a couple episodes on that where we go into a deep dive. But if that only applies to properties in a rural area. So if you're not looking at a rural area, it does not apply. So we won't do that live today. But let's start with the conventional. We're going to do purchase, 30-year fixed, pretty standard, primary, single family, 1 unit, Florida, Miami-Dade for our basic settings. We're going to keep an estimated FICO score of 760 for our scenarios here and an estimated debt to income ratio of 40. So this will allow us to quickly compare our basic programs here. So let me get through the security check. And let's check the rates for today. So pretty much the same as it was yesterday. You see we have one program that's offering a 6.75 rate for 0.875 discount points. That's a little bit lower than it was yesterday. So we appreciate, doing this show every day, seeing the different options. Yesterday, it looked like most of our programs were around this, the 6.875 for one discount point. So yesterday, not much change, a little bit lower. We always love to see some lower movement. Now, let's check out our FHA options if our borrower may not qualify for conforming or conventional. FHA does afford us a little bit of expanded guidelines beyond conventional, a little bit of expanded DTI, as well as some other credit-based guidelines that we can get around, typically with FHA. So that's typically our second option if a borrower doesn't quite qualify conventional. So we'll keep everything else the same, 30-year fixed, primary, 760 FICO, 40 DTI. And let's see what our FHA rates are to compare today. Now, they made some changes last week for FHA programs for the monthly mortgage insurance. So we do have some great news on that. That'll be live here coming up next month at all of our different programs. So pretty much anybody applying today will get to take advantage of those new costs. This quote right now, just because we haven't imported the new cost quite yet, is showing the old cost. But right now, we have our best option here. Actually, the best option would probably be this one, the second one down, the 6% rate on an FHA program for 0.75 in discount point costs. And as I mentioned, FHA does have monthly and upfront mortgage insurance. So you always want to compare the APR. In this case, it's 6.898. And as I mentioned before, the changes the HUD has made to the FHA program will afford us a little bit cheaper options here for our borrowers. So the APR should go down here soon. But APR is always used to compare across programs, so you can compare apples to apples. So I can't wait to do the show here in a couple weeks where we see this go down substantially. But anybody that applies today should be able to take advantage of the new MI. Now, let's go back to our pricer. And typically, most banks or lenders do not have any other options besides conventional, FHA, and of course, VA and USDA. Fortunately, here at the Mortgage Calculator, we specialize in non-QM. That's what we really love here. And we have over 4,500 programs under this loan type. So we're going to set up the same scenario here, but do it under our non-QM guidelines where we can use alternative income documentation. So you see here, everything else will stay the same, but we have a new option pop up for our income verification options. So in this case, we can use 1-year alt doc, 2-year alt doc. We can use asset-related programs, which we're going to talk about in detail today in our deep dive. We can do business bank statement, 12 and 24 months, very popular. Our investor programs we'll talk about here for our investment properties in a minute. And our most popular by far for our non-QM programs for someone purchasing a primary home will be to use their personal bank statement 12 months. And that is typically for our self-employed borrowers. So I'll click that option. And that's typically because our self-employed borrowers, when we're doing a conventional or a FHA loan, will have to do 2-year full documentation of their tax returns. And many self-employed borrowers may have write-offs and other things going on when they're self-employed, which do not afford them to qualify for as much home as they would like. Therefore, we use our 12 months of bank statements to then determine a new debt to income ratio using those bank statements, and typically allows our self-employed borrowers to qualify for much more home or qualify where they would not otherwise qualify. So we really love these programs. Let's check out our non-QM rates this morning. So you remember there the conventional rates were at like 6.75, 6.875, and right now we have some bank statement options in the low 7% here for one discount point, 7.375 for 0.875 discount points. But you'll see there's just a ton of options that we have here using these alternative income calculations. So we love to offer these programs. There are a great variety of them. So please get with our team to see which one of these flavors works best for you. Some of these may allow credit events such as a foreclosure or a bankruptcy or other things like that. So we love to work with these guidelines. And that's why you see some of these pricing options vary. Some may allow different credit events, but a lot of great options we love to have here for our borrowers to qualify where they would not otherwise qualify. And you see the rates are just barely above the conventional. And that's what we love to specialize in here. A lot of times, non-QM is a little bit higher than conventional, but in this market, non-QM and conventional are very comparable. So we definitely recommend for our realtors out there, for our team out there, to take advantage of all the non-QM programs, such as these bank statement programs and the programs that Jose is going to go over in a minute here for the asset-related programs. Now, before we jump into the deep dive with Jose, we always want to price our investment properties. So we love to work with investors here at the Mortgage Calculator. So let's switch it over to investment. Whether you're a first-time investor getting your first investment property or you have 100 investment properties, we love to work with those clients. We have a ton of options. So first, let's slide this over to the same scenario. We'll do an 80 loan to value, 20% down payment. Keep everything else the same as we did for our other scenarios. And we will compare our conforming conventional options for investment property to our non-QM options. Remember, FHA, VA, USDA, not eligible for investment properties. So really quick, we'll run our last two scenarios here and check out our investment property options. We'll keep everything else the same as I mentioned, and go ahead and click Show Rates and see what conventional options we have. So for investment, you'll notice that the rates are still around the same. Looks like the low 7s here for investment properties. But as I say every morning, the GSEs that are in charge of these conventional programs have added significant loan level price adjustments in the last year or so to investment properties. So we do not have any options for one discount point in cost. Looks like the best option the computer found here, 7.125 rate, which is nice, but 3.25 discount points in cost, because we just can't go higher on the rate on these conventional programs in order to reduce the cost, unfortunately. So a lot of our investors are asking us for other options. So you see, even though we go up in rate, this one, obviously going up to 7.49 for 2875, I would, show my investors some of those options, obviously. But unfortunately, there's just no one discount point cost options, which is, typically what most people want to pay, about one discount point and buy down. So that's where we love to offer our alternative. So we'd be happy to quote everybody conventional that's watching, but also we would love to quote everybody an alternative option from our thousands of non-QM programs. So let's set this back up again. And instead of conforming, we are going to use expanded guidelines non-QM for the same scenario. Investment property, everything else is going to be the same, but now we have two new options here. We have our income verification, which in this case for investment property, we're going to choose our most popular option, our DSCR option, because that actually doesn't require any income verification for our borrowers. No employment, no income documentation from our borrowers. We simply use the estimated rental income from the property in order to determine that that rental income can cover the mortgage payment, the PITIA of the property. And we even have options for properties that don't quite cover the payment. So a DSCR ratio under 1 would be a property that doesn't quite cover the expenses. And there's a lot of options for DSCR over 1, where we have different programs depending on the cash flow of the property. So tons of options here that we love to work with. And you'll notice that under prepayment penalty will pop up once we have an investment property under a non-QM program, which is pretty standard. So we'll price it as 3 years today, which is our standard option. There are options for zero prepay. That just does limit our loan programs that are available. And there are options for 5 years for people that may want to hold the property longer and don't mind a longer prepay penalty in order to reduce the cost. So 3 years is pretty standard. We will do that today and check out what our live rates are today. So it looks like at the top of the stack, a little bit different than it was yesterday. I believe this is a little cheaper. So we have an 8.25 rate for 0.475 in discount points. That's amazing. And that's for a property that does cash flow significantly. So you'll see we have a bunch of different programs here, just dozens of programs if I scroll down, with different kind of flavors, right? So there's some with a little less cash flow. There's some with just over one cash flow. And if you scroll down into the higher rates, there'll be some with less than one cash flow. So we have tons of options, tons of programs. Please get with our team so they can find which ones of these fits you or your borrower scenario the best. There are also options on here for things such as like short-term rental income, things like that. So you'll see our rates do vary from the 8s all the way up into the 9s and 10s, but those may allow things such as, as I mentioned before, foreclosures, bankruptcy, and of course, ratios under 1, and of course, short-term rental income, which is very popular these days for Airbnb short-term property, to use these DSCR programs. Just make sure we find the right program that fits your borrower. Now, before we go into Jose's deep dive, let me just explain the topic a little bit, give him a little introduction, and share my graphic here. All right, so Jose is about to take over. He's going to go into a deep dive on one of our coolest non-QM programs, which is the asset-based qualification. So there's kind of a large umbrella for these programs. They do vary, and hopefully I can stump Jose here, and we can even talk about the conventional options that still use assets as income. So there are a ton of options here for our non-QM borrowers, but also there's even little tricks of the trade here that we can use for our team in order to increase the income or even solely use assets as income for conventional loans as well. But what we'll talk about today and focus on are those non-QM expanded guideline options that use asset-based qualification. So what that means is our borrowers do not have to have a job, do not have to have income. What we're going to do is take a large asset account and employ different calculations. Different programs have different calculations, but basically we're going to take a large account, usually maybe $1 million retirement account, and say if we have to deplete this over the next 5-10 years, whatever the calculation is, what does that $1 million equal into a monthly payment for our borrower to cover that monthly cost if for some reason they had to reduce that account, use that large account in order to make the loan payments. So whether it's called asset utilization or asset depletion or assets as income, there's a lot of different flavors of this program, but essentially they all mean that we start with a large asset account and go from there and utilize a different calculation. So Jose hopefully has a couple different cool options for us here and can show us the different kind of tips and tricks. So you ready there, Jose?
Yes, sir. So just to recap what asset utilization is, it is a program that uses the borrower's liquid assets. And then depending on which program option that we're selecting, we divide those assets according to the applicable formula, and we arrive at a monthly income. So each option has different formulas. So I'm not going to generalize here regarding what it is, but just simply how it works and it has to be liquid assets. So that's cash in the bank, savings account, checking account, money market. It could be a 401k, could be an IRA, could be anything that can be liquidated that has an actual value, liquidated quickly. So in other words, no artwork, no gold bullions, no fancy sports cars sitting in the garage. It has to be liquid assets, right? So what Nick was mentioning is there is an option, which I'll briefly touch on here, Freddie Mac option that allows asset utilization as an additional income for 62-year-old and older borrowers, because the logic there is that those borrowers may be downsizing their work, working maybe less income from their current employment, but could have substantial assets, retirement accounts, 401k. So you are able to combine their regular income with asset utilization to give extra income to the 62-year-old and older borrower on a Freddie Mac loan. So look it up in the Freddie Mac guidelines handbook. It is there. That's the hack for today. So now we're going to share the more traditional option here. I have 4 options for you all. The first one is 10% down using asset utilization, and this is for a primary purchase. So you see the lowest cost option, which still has somewhat of a cost associated with it, because we're looking at our loan amount here of 450 grand. So it's about 1.75 points being charged at 10.375, and the lowest rate that you can buy down to would be 9.5%. So this is for a primary purchase, 10% down. So now we have a 15% down, which is a little bit better in the rates, as you can see, quite a bit when because that 90%, the 10% down option, 90% LTV is, not too many of those are out there. So obviously a little bit more risk on those. So they're priced accordingly. This one is more the norm, 85%. So you have 8.5% has a little bit of a lender credit, and you could buy it down to 7.375. So you recall Nick was throwing around some rates like 6.875 on a conventional. So we're pretty much doing pretty close to conventional numbers here, even though we're verifying using their assets, liquid assets. So we're now going to look at our investor cash out option. Right, kind of do a couple little cash outs here. So here, investor cash out option is at a 75% LTV. So you're looking at 8.875% is the lowest cost option, and you can still buy it down to 7.75%. Very good option at a 75% LTV. And we have our primary cash out option, which goes up to an 80%. And again, pretty amazing rates there. 8.75 gives you a little bit of a lender credit, and you can buy it down all the way down to 7.5% at a cost of $9,500, which with our loan amount of 400 grand is just a little bit under 2.5 points. So very good options there for our investors, very good option there for our primary residents. But the main point to consider is liquid assets only. Remember, no gold bullion sitting in the bank, no fancy artwork sitting in the gallery, right? It's asset depletion or asset utilization. And please refer us to the specific program guidelines regarding the formula for the calculation.
Perfect. Thank you, sir. All right. Well, great information there. Great programs available. So if you would like a quote on this, an in-depth quote, you can get with one of our loan officers. Maybe they shared this video with you already. That's perfect. Get with them and they can go in-depth on some of these programs with you and give you actual quotes within just a few minutes. If you're not working with one of our loan officers, we have over 350 loan officers all across the country. We're licensed in 21 states, and we can do business purpose loans in most states as well. Now, go ahead and go to themortgagecalculator.com, and we will pair you up with one of our loan officers. Now, at the Mortgage Calculator, our loan officers are not just versed in conventional FHA, VA, USDA like most loan officers are. As you can see with the asset-based lending that we're talking about today, we also make sure that our loan officers are well versed in all of the non-QM products, and they can be a consultant to walk you through the different products and options that may be applicable to you in your situation. So visit us at themortgagecalculator.com. You could also send us an email at info@themortgagecalculator.com, and we will pair you up with one of our loan consultants. We do this show every morning, every weekday at 11 a.m. Eastern time, so you can tune in and see how the rates fluctuate. And then we do a deep dive every day into a topic just like we did today with the asset-based loans. So tune in, 11 a.m. Eastern time. Hopefully we will see you all tomorrow. Thank you, Nick. Thank you, Jose. And thank you, everyone, for tuning in.